Sean Callow joins me now from Sydney. He's a senior currency strategist at Westpac Banking. Sean, isn't the market getting nervous about the recovery story, especially with Greece unfolding and the not-so-great data of the U.S.? Shouldn't the RBA choose to pause?
Well, certainly the market is getting a little bit skittish about it. As you mentioned, the economists are in agreement, and as you also mentioned, we're part of that. We are quite confident that they will hike rates, but the market pricing has not got to 100% at any point over the past couple of months since the RBA's last decision, and it's only down to about 60 to 65% probability at the moment. So clearly the concern is over the global economy. You mentioned the US. We've had some good news and some bad news in the US, but we've certainly had very weak stock markets, and international volatility can be a factor that the RBA will take into account. We just think that the domestic situation is sufficiently strong that they will deliver on that hike.
If the RBA decides to go against the grain and go against what you're expecting, how would you read that?
I think the Aussie dollar would certainly react pretty poorly. It would suggest that the RBA is not really nearly as confident as we thought they were about the state of the Australian economy, that they think it's still very vulnerable to a downturn in the global economy. Whereas the past year or so, the general theme has been the resilience of the Australian economy, consumer spending. We'll see another update on that later this week. The employment market, where we've had 4 consecutive upside surprises on the total employment growth, and an unemployment rate of 5.5%, which is a relatively low point in which to start a tightening cycle.
So what do we do with the Aussie right now? Do we buy the Aussie ahead of the RBA decision?
Look, I think on the day, it's probably the right call, given that we're confident on the RBA's decision, and we think the statement won't do anything to upset the markets, given that we've got that pricing of only 60 to 65%. But just overall, this week in general, it just does look as though the risk aversion is remaining quite elevated. We've had something like 88 to 85% of S&P 500 companies have beaten earnings consensus in Q4, and yet the stock market's gone down in the US, so that's obviously a bad sign. And on the commodity side, even today we've got Shanghai copper down 5% in early trade, so that's clearly not supportive for the Aussie. So people are definitely nervous.
Sean, I spoke to Credit Suisse Private Bank last week, and they were saying that they expect the Aussie to test parity within 6 months. What do you say to that? Are you expecting the same?
I think the window is closing on the parity call. Our baseline forecasts are sort of mid to high 90s for the cycle peak, but I'm thinking that if the US economy, if we get more numbers along the lines of that, the Q4 GDP, that won't be as strong as that. But if you get ongoing growth in Q1 and Q2, then US interest rate expectations could mean that the market is starting to think of US rate hikes at exactly the same time that it's starting to think of the Aussie dollar, or the RBA stopping hiking rates in Australia. So unless it gets there within the next, say, 3 to 4 months, then I don't think it'll make it at all.
Mm-hmm. I want to take a look at some of the Aussie crosses. Mrs. Watanabe apparently loading up on Aussie yen. That's a report from a phrase from your report. How much action are we seeing among Japanese retail investors in betting on the Aussie against the yen?
Well, they had a very, very long Aussie yen position last week, and clearly that's come under some pressure with the price sell-off in Aussie, particularly Aussie US. So that will have hit some automatic orders, some stop-loss orders will have been triggered there, but it is still a very appealing story from the Aussie side in general. The notion that the RBA will hike again, and that we should get some more decent numbers on the Australian economy, and at the same time, of course, Japanese interest rates are very, very low. So I think that the Mrs. Watanabe will remain inclined to buy the dips on the Aussie versus the yen, but that might be taking a little bit of pain at the moment.
Mrs. Watanabe making the right call. Should we be doing the same?
Certainly, if they've got the the desire or the willingness to stick with the trade. I think if we're talking multi-month, multi-quarter, Aussie yen can go much higher, probably at least 10% higher. Given where dollar yen is likely to go, we think it will recover. And the Aussie, while it may not quite get to parity, we think it would be broadly supported, and it should be back in the 90s on a multi-month basis. So that should add up to Aussie yen gains.
So what's the exit point, and what level should we get out of the trade?
Aussie yen, I think you're talking somewhere in probably the low 90s, perhaps. But that's honestly like a 12-month forecast. So the thing about the retail FX is that those trades are often quite short term. So it might be a better bet for Mrs. Watanabe to be buying, say, an Uridashi or a longer-term bond that might actually hold that for a couple of a year or two. That's potentially the best way to do it.
Okay, some advice there for Mrs. Watanabe. How about Aussie Kiwi? How much can the Aussie strengthen against the Kiwi from the current level of 1 Aussie buying 126 Kiwi?
I think the top side is perhaps 128, 129. So that's where we're likely to be if the RBA delivers as we expect, and if the market remains inclined to price in further RBA tightening in either March or perhaps more likely the second quarter. But of course the RBNZ will start to tighten itself, and I think that's when you can place when Aussie Kiwi will probably find it very difficult to go much further, and I don't think it'll take out 130. So you'd be wanting to go short Aussie versus the Kiwi once we get up to the point where the RBNZ is likely to tighten. So we're expecting that in late April. We expect that they'll set the scene for tightening in the March report, and that once they start tightening, as we heard from Governor Bollard on Friday, they could well hike not just 25 basis points, but 50 basis points. So that's something that could definitely see the Kiwi find some demand.
Can the RBNZ get more aggressive than the rate that you just mentioned?
Well, they're starting from 2.5%, which of course is very, very low by New Zealand standards, and they will have a lot of tightening. Once they've got enough confidence in the economy, in the recovery, then they can 50 basis points, they could at least deliver that once. We'll have to see on the timing. Our baseline view is they start with a 25, but they're warning of more aggressive moves. I don't think they would go any more than 50 basis points because that would be effectively saying that they've lost control.
Just one final question before we let you go, or before we go to break, rather. The Kiwi dollar, what's the best cross?
Look, it is very, very volatile overall. You can look at Kiwi yen again on a multi-month basis. We'd like to see that higher, but I think better to play the range against the Aussie. So wait until you get to the high, say 128 or a little higher, and then start buying the Kiwi versus the Aussie for a return to about 122.